Welcome to Stock Talk with Nico Kritikos. Today we're going to be going through Docusign. Now, Docusign is a $27 billion company, and they are the leader in e-signatures. The ticker symbol is DOCU. And to analyze the stock, we're going to be using Nico's stock market checklist, and we're aiming for at least 10 out of these 16 things in order to consider it a buy. So here is a stock chart for the past couple of years of Docusign. You can see it was trading around $300 a share a little while ago, and now we have this huge drop off of over 56% in the last 3 months. So the first thing on our list is the stock down or oversold, and yes, it is. So that one's going to get a check. Next up, this is explaining why there was such a huge drop off this past week, and it's just because billings growth was a little bit down. And it was normally 55% last year, and then now it went down to 43%. So I think people are making this too big of a deal. And the only reason this slowed down was because during the pandemic, something like e-signatures was incredibly popular and in high demand. And now it's slowing down just a little bit, but they still have a huge future ahead of them. So this is not that big of a deal. Next up, we have revenue increase and net income increase. As you can see here, revenue has been increasing nicely. However, net income has not been very nice over the last couple of years. They're still unprofitable. So the only one that gets a yes there is the revenue. Next up, healthy price to sales and healthy forward PE. Well, healthy price to sales, right now they have a current price to sales of 13 with 40% revenue growth expected for the year, and a forward price to sales of 10 with 30% revenue growth expected for next year. So I consider those very healthy numbers, especially because the stock dropped so much now. The metrics look super cheap. And then next up, we have healthy forward PE. A 61 forward PE is more expensive than most stocks, but for the amount of growth this company has ahead of it, it's really not that bad. Because there's some companies like Square or Shopify or Tesla that have forward PE ratios of 200 or 300. So 61 is not terrible. And they have 29% EPS growth expected for next year. And in the past 18 months, its forward PE traded from anywhere between 115 to 200. So a 61 is not that bad. This is going to get a yes. Is the company innovative? Do they have a moat? I put yes, because they're very innovative with the way they do e-signatures, and digital signature is a technology that is here to stay. Now, they don't have much of a moat, but they are still number one in the industry, so I consider that a yes. Is the industry growing? Yes, 33% CAGR expected for the next 5 years, and so those are both going to get a yes. Those are both looking good. Number 8, return on invested capital. Their return is negative, so that's going to get a no. Margins are gross margin of 77%, but the bottom line is negative, so that gets a no too. Then we have cash flow. Operating cash flows are growing nicely. As you can see here, I mean, it's not great, but it's definitely improving. And then they're investing heavily into growing their top line revenue. That's why they're not so worried about bottom line right now. But you can see operating cash flow getting a little bit better, free cash flow getting a little bit better, and their end cash position is still staying strong. So that's going to get a yes. Diverse revenue streams. They have over 1 million paying customers now, which is great, but 95% of their revenue comes from their subscriptions, which is not very diverse. So that's going to get a no, because I'm looking more for different types of products and services or different types of business models. They don't really have that. Next up, here's their growing customer base. You can see over the past couple of years, they've gone from 2018, 373,000 paying customers, to now over 1.1 million. So that's also a great number there. Next up, balance sheet. We have more long-term assets and long-term liabilities. That gets a yes. This is one of my only problems I have with this company. I don't really like this. Short-term assets is less than short-term liabilities. That's going to get a no. And then their equity, this is what I don't like. Their equity has been going down over the past couple of years. And you can even see over the past year, it's gone from 426 million to 211 million. So not that great there. That's the only thing I'm kind of disappointed with. Share buyback or a dividend. They had a 6% share increase in the past year. So it's going to get a no. They're just diluting shareholder value, but it is understandable to some degree because they are a new company not new, but they're a growing company. They're still young and they're not profitable yet. So it kind of makes it makes sense. But next up we have is the big money interested. This means hedge funds, big investors. I put yes because Vanguard has a big position, BlackRock has a big position, and there's close to 1,000 funds holding this as of last month. Probably not. There's probably a lot less now because of the big sell-off, but it's those big funds are interested. So in total, we only have a 9 out of 16. So technically, this was not get a buy rating, but I'm still very interested in buying this. Now, if we look at my prediction, we can see that the global digital signature market size is projected to grow from $4 billion in 2021 to $17 billion in 2026. This is a compounded annual growth rate of 33%. And we know that Docusign receives 95% of their revenue from subscriptions. So if Docusign can maintain a 25% market share, which is pretty, right now they have like 50 or 55, I think 50 to 60% market share. So in 5 years from now, they're probably gonna have a little bit less. 25% is still a very strong number. Most industries don't have competitors that have that much market share, but 25% is on the higher end, I think. And that means that they'll get $4.25 billion of revenue in 2026 if they can maintain that market share number, and if the market size is that big. And I put a price to sales of 15. I think that's pretty fair. I think a 10 would be too conservative. I think a 10 is kind of cheap because this company is probably going to have strong growth numbers until like 2030. And I think this could be a price to sales of 20, honestly. I think if you go above 20, if you go to 25, that's probably pushing it. So I think around 15 to 20 is probably a fair mark. And they are claiming long-term that they have a $50 billion TAM, total addressable market. And so, but I think they're thinking more like 10 years out. And so I think a price to sales of 15 should be fair. So at a price to sales of 15, that's going to put them at a $64 billion valuation, or $319 a share. And this means a 136% increase from the current share price of $135. So I am pretty bullish on this stock. I mean, I might have to make a position in this starting on Monday. So we'll see what happens. I mean, it could go down a little bit more. Maybe it goes closer to $100, but this company is definitely coming back because they're number one in the industry, and that industry is going to keep growing. So I'm pretty bullish. I kind of do consider this a buy. So let me know what you guys think down below.